Bill Ackman is one of Wall Street's most recognized hedge fund managers. He's worth over $9 billion, runs Pershing Square Capital, and is famous for bold, high-conviction bets that made him billions. But here's the twist. For every high-profile win, Ackman has also suffered massive losses. We're talking about mistakes so big, they cost him and his investors tens of billions of dollars. In today's video, we're going to break down the 3 biggest failures of Bill Ackman. We'll explore what went wrong, why it went wrong, and most importantly, the lessons that everyday investors like you and me can learn from them. So grab your coffee, because this is going to be one of those stories that blends drama, rivalry, ego, and some of the most expensive lessons in modern investing history.
Part 1. The Herbalife War, 2012 to 2018. Let's begin with perhaps Bill Ackman's most public and dramatic failure, his war against Herbalife. It was December 2012. In a packed ballroom in New York City, Ackman walked onto the stage armed with a 342-slide presentation that he had spent months preparing. For more than 3 hours, he laid out his case. Herbalife, a global nutrition and supplement company, was nothing more than a pyramid scheme disguised as a business. He didn't stop there. He revealed that his hedge fund, Pershing Square, had placed a massive short position of about $1 billion against the company, which later grew to roughly $1.3 billion. For many in the room, this was shocking. Ackman wasn't just betting on a stock, he was declaring war. He said Herbalife preyed on vulnerable people, immigrants, low-income families, selling them dreams of financial freedom, when in reality, most distributors earned little to nothing. To him, Herbalife wasn't simply a flawed business model, it was a fraud, comparable to a Ponzi scheme. At first, it looked like Ackman had struck gold. On the day of his presentation, Herbalife stock dropped sharply, falling more than 10% intraday. Investors panicked. The media ran with the story. It seemed Ackman had exposed a corporate giant and was about to collect billions.
But then came the counterattack. Enter Carl Icahn. If Ackman was the crusader, Icahn was the street fighter. A legendary billionaire investor with a long-standing grudge against Ackman, Icahn saw an opportunity, not just to make money, but to embarrass his rival. In February 2013, Icahn began buying Herbalife shares aggressively, eventually becoming one of its largest shareholders. And then, the showdown spilled onto live television. On CNBC, viewers watched as Ackman and Icahn shouted over each other in one of the most heated on-air clashes Wall Street had ever seen. Icahn called Ackman a crybaby. Ackman accused Icahn of being a bully. Millions of viewers tuned in, not for stock analysis, but for the theater of 2 billionaires locked in personal combat.
He tried to settle with me. He offered $10 million to my favorite charity over a dinner that we had at his favorite Italian restaurant.
What's his name? Hello?
Anyway, so again, I think this is not a great use of CNBC airtime.
Well,
what I can tell you is this is not an honest guy, and this is not a guy who keeps his word, and this is a guy who takes advantage of little people. That's what it is.
Let's make good use of it, or better use of it then. Carl, why don't you just come clean on the Herbalife thing? Are you long or not? Right, I mean, the whole market knows or suspects that you are.
I didn't get on to be bullied by you, okay? If I could talk, let me talk, but I don't need you to... Hello?
Yeah, I'm here. No one's bullying you, Carl. I mean, I'm just, you're the one who called in to our show to talk to Bill Ackman, and the principal issue is the Herbalife thing.
Listen to me. I was called in by Max Meyer to have a conversation, not to argue with you. All right? If you want to take... Hello?
Yeah, we're listening.
Well, if you're listening, let me talk. I want to say what I want to say, and I'm not going to talk about my Herbalife position because you want to bully me. All right?
I'm not bullying you. I'm asking the question everybody wants to know, Carl. That's all. But you can make your statement.
What you want to know. I'm going to talk about what I want to talk about. And if you want to take that position, I'll never go on CNBC, So you can say what the hell you want, but I'm going to tell you, I'm going to talk about what Ackman just said about me, not about Herbalife. And I'll talk about Herbalife. when I goddamn want to, not when you ask me.
Okay.
I'm never going on a show with you again. That's for damn sure, okay? So let's start with what I want to say. Ackman is a liar, okay? To begin with, I've lived my life from 1960s and 70s by handshakes. I almost lost my firm a few times by handshakes. Ackman he does pump and dump. He's got one of the worst reputations on Wall Street. And I'm going to tell you, this Herbalife is a classic example of what he does. Let's look at Herbalife. Ackman was doing badly in 2012. He was down 2-3%. He probably woke up in the morning and said, let's see what company we can destroy and put out a bear raid on it. It's happened from the late 80s till now. And go do a bear raid, kill the stock, and now we can show our investors we made more money. And by the way, if we can mark these things and make more money, he says that he's not taking the profit, but that gives him a better rate of return for himself. Ackman has done that. If you read the articles about him, he's done it all his life. And I will swear to you, and I don't need. We didn't make a lot of money on this goddamn crazy thing I did with him. We made $4 million, but I was incensed because I will tell you that without question, I will swear to it on any Bible you want that I had a verbal agreement with him that he was not going to get any piece of the money. And at the end, he was, as he said, he was in major, major trouble, and he's basically lying.
And while Ackman was making his moral case, the market was making its own judgment. Instead of collapsing, Herbalife's stock surged. Icon's confidence gave other hedge funds the green light to buy in. Soon, Herbalife's share price was climbing higher than ever. Ackman didn't back down. For years, he poured resources into the fight. He hired private investigators. He launched PR campaigns. He lobbied regulators, urging them to shut the company down. And for a while, it looked like he might get his wish. The FTC and even the FBI opened investigations into Herbalife's business practices.
But the outcome wasn't what Ackman hoped for. In 2016, Herbalife agreed to pay $200 million and restructure parts of its business, but regulators stopped short of calling it a pyramid scheme. Herbalife survived. By 2017, Ackman began quietly cutting back his short position, replacing it with put options to limit further losses. And in early 2018, after 6 years of obsession, he finally walked away, closing the position at an estimated loss of roughly $700 million to $1 billion. It was a devastating defeat. What had begun as an investment thesis turned into a personal crusade, fueled by ego and rivalry. Ackman's reputation took a major hit, and Herbalife remained standing. Lesson from Herbalife: don't let ego drive your investments. Ackman's mistake wasn't just being wrong about Herbalife, it was doubling down, making it personal, and refusing to cut his losses. In the stock market, stubbornness can be the most expensive trait of all. Part 2. Valeant Pharmaceuticals, 2015 to 2017. If Ackman's battle with Herbalife was driven by ego, then his disaster with Valeant Pharmaceuticals was driven by misplaced trust. By 2015, Valeant was one of the hottest stocks on Wall Street. Its business model seemed ingenious. Instead of spending billions on research and development like traditional pharmaceutical companies, Valeant focused on acquisitions. It would buy existing drug companies, slash their costs, and then raise the prices of their medications, sometimes by several 100% overnight. To investors chasing quick profits, this strategy looked brilliant. From 2008 to mid-2015, Valeant stock soared from just a few dollars to over $260 a share. Hedge funds loved it. Analysts praised it. Valeant was being called the next Berkshire Hathaway of pharma. Bill Ackman was convinced. He poured more than $4 billion of Pershing Square's capital into the company, eventually becoming one of its largest shareholders with nearly 9% ownership. But then, the cracks began to show. In 2015, journalists and politicians started raising alarms about Valiant's business practices. Stories of outrageous price hikes dominated headlines. For example, the price of Isoprel jumped more than 500% overnight, while Nitropress rose nearly 300%. Patients, hospitals, and insurers were outraged. The company was accused of exploiting the healthcare system for profit. And then came the accounting questions. A little-known pharmacy called Philidor RX Services was revealed to have deep, undisclosed ties to Valiant. Critics alleged the company was using Philidor to inflate sales and manipulate revenue recognition. Suddenly, Valiant wasn't just a controversial company, it was a potential fraud. The market reacted brutally. Valiant stock began to collapse. From its peak of $260, it spiraled downward, eventually trading below $10 a share. For Bill Ackman, the losses were catastrophic. His multi-billion-dollar investment was nearly wiped out. Despite sitting on Valiant's board, Ackman seemed powerless to change the company's course. By March 2017, after months of defending the investment, he finally admitted defeat and sold Pershing Square's entire stake, locking in a loss estimated at around $3 to $4 billion. The Valiant episode damaged Ackman's reputation more than any other. Critics said he had fallen in love with management, particularly CEO Michael Pearson, and ignored the mounting red flags. He had bet not just his money, but his credibility on a business model that turned out to be unsustainable and deeply unethical. Lesson from Valiant: don't put blind faith in management or fall for a business model that seems too good to be true. Ackman trusted Valiant's executives and overlooked warning signs. For investors, real due diligence means looking past short-term profits and asking harder questions. Is this model sustainable? Is it ethical? Is it transparent? If the answer is no, the risk is too great, no matter how tempting the rewards look. Part 3. Target, 2007 to 2009. Before the high-profile battles of Herbalife and the painful collapse of Valiant, Bill Ackman had already lived through one of his toughest investing lessons: Target Corporation. Back in 2007, Ackman saw what he believed was a golden opportunity. Target was one of America's most successful retail chains, but Ackman argued that the market was undervaluing the company's assets, especially its vast portfolio of real estate. He had a bold idea. If Target spun off its real estate into a separate publicly traded real estate investment trust, or REIT, shareholders could unlock billions in hidden value. Confident in his thesis, Ackman went big. Through Pershing Square, he invested roughly $1.8 to $2 billion into Target, not only by buying shares, but also by purchasing call options, a leveraged bet that the stock price would rise. If his thesis played out, the upside could be enormous. But then the world changed. In 2008, the global financial crisis struck with full force. Consumer spending collapsed, retailers across the board were hammered, and Target was no exception. The stock price plummeted as shoppers tightened their wallets and the U.S. economy fell into recession.
For Ackman, the pain was amplified by his strategy. The call options he had purchased carried an expiration date. Unlike common stock, which can be held through downturns until recovery, options can become worthless if the stock doesn't move in your favor quickly enough. That's exactly what happened. By the time those options expired, Target's stock had not recovered enough. The result? Pershing Square lost an estimated $1.4 to $1.5 billion. It was a devastating hit, and one that Ackman himself later admitted was among his worst mistakes, not just because of the money lost, but because of how the trade was structured.
Instead of owning Target stock outright, which eventually did rebound in the years after the crisis, Ackman had leveraged his bet with options. When the crash came, there was no room to maneuver, no second chance. The entire strategy collapsed like a house of cards. Lesson from Target: leverage is a double-edged sword. Options can supercharge gains, but they also magnify losses. For long-term investors, relying too heavily on leverage is like building on shaky ground. It works until the storm comes. And when the storm is as big as the 2008 financial crisis, no amount of confidence can save you. And that brings us to the end of our story, the 3 mistakes that nearly broke Bill Ackman. Herbalife showed what happens when ego turns an investment into a personal war. Valiant revealed the dangers of placing blind faith in a business model that looks brilliant on the surface but is rotten underneath. And Target taught us the painful reality of leverage, how betting too aggressively in the wrong market at the wrong time can wipe out billions. But here's the remarkable part. Despite losing more money than most people will ever see in a lifetime, Ackman is still standing. More than that, he remains one of the most successful hedge fund managers on Wall Street. He rebuilt his reputation, staged incredible comebacks, and even made billions by hedging against the COVID-19 crash in 2020. So what does this tell us? That even the smartest investors, with all the resources and research teams in the world, are still human. They make mistakes, sometimes massive ones. The difference between failure and survival lies not in being perfect, but in how you recover, what you learn, and whether you stay in the game.
Bill Ackman's story is a reminder that investing is not about always being right. It's about managing risk, learning from failure, and surviving long enough to benefit from the times you are right. So next time you're tempted to go all in on a stock because you're sure it's going up or down, remember even billionaires like Ackman have been humbled. If you found this breakdown helpful, make sure to hit that like button. Subscribe for more deep dives into the world of investing, and let me know in the comments which of Ackman's mistakes do you think was the most avoidable. Thanks for watching, and I'll see you in the next video.